Okay, welcome to this session of strategic financial management. In our last session, we were discussing regarding institutional setup which provides working capital for industry, and we had studied seven of them. Let us now study the next few institutions which provides these financial assistance. And one among those is SFCs or state financial corporations. Now, speaking about this, IFCI or Institution for Institutional Financial Corporation of India provides financial assistance only to large sized industrial undertakings. Now, in order to cater to the needs of small scale units, the Government of India passed the State Financial Corporation Act in 1951, under which these SFCs or State Financial Corporation were set up. The first State Financial Corporation was set up in Punjab in 1953, and for the present day there are 18 SFCs functioning in the country. Now, these state financial corporations are managed by a managing director, board of directors, and executive committee is headed by a chairman. The functions of SFCs can be discussed as: first among all, it advances term loans to small scale and medium scale industrial units. It also underwrites the issue of stocks, shares, debentures, and bonds of these small scale and medium scale industries. Now, along with other functions, SFCs also grants loan to the industrial concern which is repayable within a period not more than 20 years. And it also subscribes to the debentures that are floated by the industrial concerns in the market. Along with all this, it also provides financial assistance to small road transport operators, maybe tour operators, hotels, hospitals, nursing home, and other such business organization. Now, speaking about the next one, it is called as Nabard, or a National Bank for Agricultural and Rural Development. Now, speaking about Nabard, it is an apex development bank in India for all kinds of rural credit, having its headquarters in Mumbai, state of Maharashtra, and its all other branches are spread all over the country. Now, there was a committee set up by government to review arrangements for industrial credit for agricultural and rural development, which was called as Card, which was set up by Reserve Bank of India under the chairmanship of B. Sivaraman, and they conceived and recommended the establishment of Nabard, or National Bank for Agricultural and Rural Development. And with the recommendation of the Card Committee, Nabard was established on 12 July 1982 by a special act by the Parliament, and it mainly focuses on uplifting rural India by increasing credit flow for elevation of agriculture and non-farm sector. Now, this Nabard has been accredited with matters concerning policy, planning and operations in the field of credit for agriculture and other economic activities in rural areas in India. Now, speaking about RBI, RBI sold its stake in Nabard to the Government of India, which now holds 99% of stakes. It is active in developing financial inclusion policy and is a member of the Alliance for Financial Inclusion. Now, speaking about the objectives of Nabard, uh, Nabard was established in terms of preamble to the Act stating, I quote, for providing credit for the promotion of agriculture, small scale industry, cottage and village industry, handicrafts and other rural crafts, and other allied economic activities in rural areas with the view to promoting IRDP and securing prosperity of rural areas and for matters connected therewithin identical thereto. Unquote. Now, speaking about the objectives of Nabard, which has been stated in the statement, which when the bill was proposed in Lok Sabha, is this particular national banks will be an apex organization when it comes to all the matters relating to such as maybe policy planning, operational aspect in the field of credit for promotional of agriculture, small scale industry, cottage and village industry, handicrafts and other rural crafts and other allied economic activities in rural areas. Now, this Nabard or this bank will serve as refinancing institution for institutional credit such as long term, short term, and even for the promotion of activities in rural areas. Now, the bank will also provide direct lending to any institution as may be provided by the central government. Now, the bank will have organic links with the Reserve Bank and maintains a close link within. Now, speaking about Nabard, it as we discussed, it is the apex institution in the country which looks after the development of cottage, small industry, village and all other rural industry. Now, Nabard also reaches out to allied economics and supports and promotes integrated development and to help Nabard discharge its duty. Now, certain roles have been given to Nabard. First one, Nabard serves as an apex financing agency for the institutions providing investments and production credit for promoting the various development activities in rural areas. Nabard takes measures towards institution building for improving observative capacity of the credit delivery system, including monitoring of fund, formulation of rehabilitation schemes, restructuring of credit institutions, training of personnel, and other such activities. Along with that, it also coordinates the rural financing activities of all institutions engaged in developmental work at the field level and maintains liaison with Government of India, state governments, Reserve Bank of India, and other national level institutions concerned with policy formulation. And Nabard also undertakes monitoring and evaluation of projects refinanced by it. Now, speaking about one more institution, it is State Industrial Development Corporation or SIDC. Now, when it comes to Indian states, most of the states have set up State Industrial Development Corporation, which would help for the rapid industrialization of all the states. There are 24 SIDCs working in different states of the country. Now, these corporations provides financial assistance to small entrepreneurs and particularly to those industries which are developed in backward areas. Now, during the year 1992 and 1993, these corporations sanctioned assistance to the extent of 1,140 crores as against 1,100 crores advanced during the previous year, and by the end of March 93, the aggregate amount of loans sanctioned by SIDC was 7,710 crore rupees. Now, these are some of the institutional setups which helps in bringing working capital to the business organization. The list is not exhaustive. There are still other institutions. Now, I have said these 10 institutions and how it works when it was established in a very, very brief manner. It is expected of you that if at all you wish to know more, you will have to do a self study of all the institutions that are available. Along with this, there are other institutions like Ministry of MSME of Government of India. Now, Ministry of MSME is nothing but Ministry of Micro, Small and Medium Enterprise. There is Mudra Bank, which abbreviates as Micro Units Development and Refinance Agency Bank. You have Tourism Finance Corporation India, you have State Bank of India and other public sector banks also. So the list is not exhaustive. You are recommended to do self study in this particular topic. Now, continuing further, the next topic is NBFCs or non-banking financial companies. Now, speaking about NBFCs, uh, to tell about this, these are companies which are registered under Companies Act of 1956, and they engage in giving loans and advances for especially business organization for acquisition of shares, stocks, bond, hire purchase insurance business, or chit fund business. But one thing it should be remembered that is it does not include any institution whose principal business includes agriculture, industrial activity, or the sale, purchase, or construction of immovable property. Now, speaking about NBFCs, the Reserve Bank of India Act of 1934, amended on 1st December 1964 by Reserve Bank Amendment Act 1963. And in this particular amendment, there was a chapter called as Chapter 3B. It introduced to regulate depositing accepting NBFCs. Now, in the early 1970s, Government of India asked Banking Commission to study the functioning of chit funds and examine activities of non-banking financial intermediaries. Later in 1972, Banking Commission recommended uniform chit fund legislation to whole country, and because of this recommendation, Reserve Bank of India prepared a model bill to regulate the conduct of chit funds and referred to the study group under the chairmanship of James S. Raj, or what we call as James S. Raj Committee. And in the year 1974 June, this study group recommended ban on price cheat and other schemes and directed the Parliament to enact the bill which ensures uniformity in the provisions that are applicable to chit funds throughout the country. Now, because of all these recommendations and the reviews of the committees, Parliament enacted two acts, Price Chits and Money Circulation Schemes Act 1978 and Chit Funds Act 1982. Now, speaking about NBFCs, there are different types of NBFCs. Speaking of which, the first one is Asset Finance Company, or what we call as AFCs. Now, speaking about this Asset Financial Company, it is a company which is, of course, a financial institution, and it carries on its business principally helps in the financing of physical assets which supports productive or economic functions. Now, speaking about this productive or economic function, it could be such as automobiles, tractors, lathe machines, cranes, generator sets, earth moving, material handling equipment. and also moving on own power and general purpose industry machines. Now, principal business for this particular purpose of asset financing company can be said as aggregate of financing real or physical assets, supporting economic activity, and income therefrom should not be less than 60% of its total assets and total income. So that is all about a asset finance company. Now the next one is investment company. Now speaking about this investment company, it means any company which is a financial institution and carries on its principal business with the acquisition of securities. The next one is loan company. Now speaking about this loan company, it means companies which is a financial institution and carries on its business to be in the field of providing finance, whether by making loans or advances or from any activities, but it should be noted that it should not include any asset finance company. That is to tell, any institution that does all the function of asset finance company but is not included there within is considered as loan company. The next one is infrastructure financial company or IFC. Now speaking about this, infrastructure finance companies, it deploys a minimum of three-fourths of their total assets, especially in infrastructure loans. Now the net owned funds are more than 300 crores and the minimum credit rating of A and the capital to risk weighted assets ratio is 15% under such institutions. Then the next one is infrastructure debt fund of non-banking financial company. Now speaking about this, IDF NBFC usually is a company registered as NBFC which facilitates the flow of long-term debt into infrastructure projects. Now IDF NBFC raise resources through multiple. Now only infrastructure finance companies can sponsor for IDF NBFCs. Not all other types of NBFC, but only infrastructure finance company can sponsor IDF NBFCs. Now the next one is NBFC factors. Now speaking about NBFC factors, it has principal business of what we discussed earlier to be factoring. Now to tell about factoring, it is a financial transaction and a type of debtor finance. Now one more is gold loan NBFCs in India. Now over the years, if we observe, gold loan NBFCs witnessed an upsurge in Indian financial market. Now, owing mainly to the recent period of appreciation in gold price and consequent increase in the demand for gold loan by all the section of society, especially the poor and medium class, to make ends meet. Now, speaking about Indian scenario, though there are many NBFCs offering gold loans in India, about 95% of the gold loans is handled by three Kerala-based companies, especially Muthoot Finance, Manipuram Finance, and Muthoot FinCorp. Now, growth of gold loan NBFCs eventuating from various factors including asset under management or what we call as AUM, the number of branches and also the number of customers. The growth of these gold loan NBFCs occurred both in terms of size of their balance sheet and also their physical presence that compelled to increase their dependency on public funds, including bank finance and also non-convertible debentures. Now, aggressive structuring of gold loans resulting from the uncomplicated, undemanding, and fast process of documentation, along with higher loan to value ratio, includes some of the major factors that help the growth of gold loan NBFCs in India. The next one is residuary or residuary non-banking companies or RNBCs. Now, residuary non-banking companies is a class of NBFC which is a company and has its principal business in which it does the work of receiving of deposits under any schemes or arrangements or in any other manner and not being investment, asset, financing or loan companies. Now, these companies are required to maintain investment as per directions of RBI in addition to liquid assets. Now, speaking of this NBFCs, it is good to understand or discuss the difference between NBFCs and banks. Now, speaking about this, NBFCs perform the functions similar to that of banks, but there are some few difference. Now, this NBFCs provides banking services to people without holding a banking license, and a NBFC can never accept demand deposits. Now, this NBFC is never a part of the payment and the settlement system. Now, a NBFC can neither issue checks drawn on itself. Now, deposit insurance facility of the Deposit Insurance and Credit Guarantee Corporation is also not available for NBFC depositors unless or unlike bank. Now, an NBFC is not necessary to maintain CRR or SLR, or in other words what we call as reserve ratios. Now, reserve ratios, CRR refers to cash reserve ratio, SLR refers to statutory liquidity ratio. Other than that, a NBFC cannot indulge primarily in agriculture, industrial activity, or sale, purchase, construction of immovable property. Now, under NBFC, foreign investment is also allowed up to 100%. Now, it is very important to maintain the regulations of NBFCs. Now, especially the focus of regulatory attention is on NBFCs which accept public deposits. Now, recent years have witnessed significant increase in financial intermediation by these non-banking financial corporations. And for the regulatory purpose, these NBFCs have been categorized into three different kinds. First one being those which accept public deposits. Second one, those which does not accept any public deposits but engaged in financial business. And the third one being those NBFCs whose core investment companies with 90% of their total assets as investments on securities of their group or holding or subsidiary companies. Now, as per this NBFC acceptance of public deposit directions, which were given in 1998, the amount of public deposits in respect of NBFC was linked to credit rating from an approved agency so that it enables the depositor to make an informed decision. Now, these NBFCs were also encouraged to broad base their resource through borrowings from banks and financial institutions, intercorporation deposits or loans, secured bonds or debentures, which were exempted from the definition of public deposits. But however, the Association of NBFCs and the apex trade bodies brought to the notice of both the government and of the Reserve Bank of India the problem of the asset liability mismatch caused by frequent downgrading of the credit ratings of NBFCs and the consequent reduction in quantum of permissible public deposits. And these committee also have suggested that smaller NBFCs could be exempted from the requirement of credit rating for having public deposit up to a particular limit, while large NBFCs could be allowed higher limits of public deposits subject to minimum investment grade credit rating and higher capital adequacy requirement. Now, there was a task force which was appointed on NBFCs by the government of India, and it submitted its report in October 1998, and the recommendations were given that rationalization of regulations for NBFCs was necessary, improvement of the legislative framework for protecting the interests of depositors, and development of NBFCs on sound and healthy lines is also very much required. Now, the recommendation of this committee has been listed, some of which I have already made a point of those, and I would be giving it in the study material. Please do go through those. Okay. Now, the last in this particular chapter is MFI, or what we call as microfinance institution. Now, a microfinance institution is one among such financial organization which gives the financial service especially to people who have low income. Now, almost all financial institutions give loans to their members, and there are other institutions among those which may offer insurance, deposits, and other services also. Now, a great scale of organizations are regarded as microfinance institutes. Now, they are those that offer credits and other financial service to the representatives of poor strata of population. Now, these microfinancial corporations also go for non-banking financial license. Now, an increasing number of microfinance institutions are seeking NBFC status from Reserve Bank of India with the main intention to get wide access to funding, including bank finance. Now, there are some of the exemption granted to NBFCs which are engaged in microfinance activities. Now, the task force which was put on NBFC on supportive policy and regulatory framework for microfinance was set up by Nabard in 1999, and it provided various recommendations. Accordingly, it was decided to exempt NBFCs which are engaged in microfinancing activities licensed under Section 8 of the Companies Act 2013 and which do not accept public deposits from the purview of Section 45IA, 45IB, and 45IC of RBI Act of 1934. Now, this Section 45IA of Companies Act 2013 speaks about the registration. 45IB speaks about maintenance of liquid assets, and 45IC speaks about transfer of profits to the reserve fund. Now, speaking about this MFIs, there are MFIs and SHGs through via different bank linkage program. SHGs are nothing but self-help group. Now, in a joint fact finding study on microfinance conducted by the Reserve Bank of India and few major banks, speaking about this microfinance, some of the MFI financed by banks or acting as their intermediaries or partners appear to be focusing on relatively better banked areas, including areas covered by self-help group banking linkage program. Now, competing MFIs were operating in the same area and trying to reach out to the same set of poor, resulting in multiple lending and overburdening of rural households. And there are many MFIs supported by banks were not engaging themselves in capacity building and or either empowerment of the group to what extent that was desired. Now, these MFIs were disturbing or disbursing loans to the newly formed groups within 10 to 15 days of their formation, in contrast to what was in practice. Now, obtaining in the self-help group bankage linkage program which takes about 6 to 7 months for group formation and nurturing. So, as a result, cohesiveness and a sense of purpose were not being built up in the groups formed by these microfinance institutions. Now, banks as the principal financiaries of MFIs do not appear to be engaging them with regard to their systems, practice, and lending policies with a view to encourage or ensuring better transparency and adherence to best practices. Now, speaking about this MFCs of India, there are Bandhan Bank as well as two other Indian MFCs, Microcredit Foundation of India and Sadhana Microfinance Society have been placed above Bangladesh-based Grameen Bank, which along with its besides Bandhan, the Microcredit Foundation of India and Southern Microfinance Society and other Indian entries include Grameen Kota, Sharada's Women's Association for Weaker Section, SKS Microfinance Private Limited, and Asmita Microfin Limited. Now, hereby we finish our sixth chapter. So that reminds me that we have completed two chapters among the 8 chapters that we have under strategic financial management. In the coming session, we shall move forward for the seventh chapter that is there in your syllabus. Now, regarding institutional setup or this particular chapter, you have to mainly focus on what do you mean by term finance and working capital finance and how under Indian scenarios there are various institutions which help us bring in these funds to the organization. Now I have taken down your attendance also. So if at all the meeting gets stopped, you can leave the meeting. But before that, please do a self-study regarding all these banks. Okay? And do not get confused and please do not take this particular chapter lightly because at least one theory questions will definitely come from this chapter, and if at all you put at least 2 or 3 hours of effort in understanding this financial institution, it will be a very easy question for you all to attempt during your semester exam. For that matter, maybe any of the theory that you have. When it comes to strategic financial management, see to that you do not skip any of the theory because first it is easy to understand, second is it will always help you in scoring more when you compare the practical problems of strategic